and interest rates and investment properties and,
Yeah.
and all kinds of good stuff. Thank you for being here.
Yeah, thanks for having me on here. Happy New Year.
Yeah,
Haven't seen you in a little bit,
Yeah.
so thanks.
Yeah, Marquette got me these just so we get more green like that.
Oh, that's nice.
She got
I
me
like that.
green glasses and a whole bunch of
I
them.
feel like I need to get some of those. That's Fairway's colors. So
we
I
could
feel like, yeah.
we could totally set you up.
Yeah,
She
hey,
knows
I'll
where
take
to
them.
find them.
I'll
Yeah.
take what I can get.
Yeah. So talk to us a little bit about financing, how it works, how it can be made easy.
Yeah.
You know, when I'm about to call, most people are about to call their lender. There's some anxiety about, oh gosh, this is going to be tough. How do we smooth that out? And what should they do for?
Yeah, I mean, I think it's difficult to smooth it out. I think initially people have a ton of apprehension because they're worried about getting taken advantage of. They're worried about not being led in the right direction.
Right.
And so I think for any person that's starting to look into purchasing a home, they should be, one, taking advice from the realtors that are helping them, because in general, you have partners that you work with that you trust, and they do a good job. They have a history of doing a good job. Right. That's one place where you can start looking. And if you don't have that or want more options, you should definitely shop around. I mean, I tell my clients all the time that I know what our company offers. I know the type of service that we provide. So I don't hesitate at all to tell a person to go ahead and shop and find out where different companies are.
Well, so they have perspective and they can see like really where their best deal is.
Not just the numbers, right? But what type of service, what type of experience are they going to have throughout this process?
Right.
Sometimes I do feel that people get really caught up with what the exact number says on the dot, you know, a month or two before they're closing. A lot of the times, if you're looking into new construction, the deal is 6 months away.
Gosh, yeah.
And so they compare lenders 6 months away and they say, oh, well, this person's giving me a deal that's $1,000 better. I'm just going to go with them now. And then eliminate everybody else. 6 months from now, that deal could be completely different.
Well, they really need to check in, at 3 months or a little bit?
Yeah, I would say that you want to check in close enough that you can actually lock the terms of the loan. So if you're buying a new construction home, and I feel like I could go on for days about new construction, I feel like I need to do a separate one.
That might be a different one, yeah.
Yeah, but if you're looking at new construction, you absolutely want to wait until you're close enough to lock the terms of the loan. Because anytime you're buying new construction, I feel like there's blood in the water. Yeah. There are tons of lenders that are going to tell you everything that you want to hear because it's so far away. They know that there's no way for them to be able to guarantee those terms. If they can get other people out of the way now, then they might be in a better position down the road with just them left behind.
That's interesting.
That's a perspective from the job that I do.
Yeah, no, I get it. Like if I'm a racehorse, I'm going and I want to knock the other guys out of the way.
So I just tell people, wait until you're about 30 days, 40 days from closing. That's a realistic time frame to be able to actually lock the terms. Yeah. Then you can compare all of the lenders that you have, working.
Are you locking 60 days out, or
you can
a month, or like what's that look like in general?
You can do extended locks. You can do 60-day locks. You can do 90, 120-day locks.
What's the one that costs me nothing?
Essentially, usually what you're looking at is a 30-day lock, a 15 or 30-day lock.
Okay, so when you're in 30 days, that's a good time.
That's when you want to really lock the terms of the loan, because you're not usually getting the length of the loan priced into the rate. If you're looking at a 120-day lock, I mean, the rate is going to be massively worse than the rate that you would have gotten at 30-day lock.
Right.
And so the interest rate conversation can be complicated because there are so many factors. The type of property that you're buying, is it a condo? Is it a single family? Are you doing 3% down or 5% down or 10% down or 15% down? And how long do you need this lock for? Are we doing 120 days, or are we closing this deal in 15 days or 30 days?
Yeah.
The shorter the lock, the better.
Resale or new construction or something funny going on.
Right, exactly. And one really great question, and I won't spend too much time harping on it because I feel like I'll confuse everybody that's listening. But one question you always want to ask of the people that are managing your finances, your lender, is what is your par rate? What is the rate that I'm being given at zero cost to me? So there are a lot of factors to that.
Find a baseline there.
Exactly, because there are a lot of factors, the days, the down payment, all of that. But once you settle all of those variables, there's a rate represented by what's called par, basically zero price cost to the lender and zero price cost to the buyer.
It's an even deal because you guys make money either on the spread or on the points.
Mm-hmm.
Is that right?
Exactly right. Yeah. So that is where we start getting into the conversation of how these programs are being marketed to clients. You start hearing a lot of terms out there, 0% down, we'll pay for your closing costs. And I'll tell you, and I'm sure there are a lot of lenders that will hate me for saying this, but there's no such thing as free money. There's just not. Yeah. And regardless of the type or the way that the mortgage is structured, there's a way in there to make sure that the lenders are making the margin that is required. So you have to be very careful when someone says to you that they're going to pay for your closing costs, at least the mortgage side is, because in general what's happening is that your interest rate is going up to be able to create the margin necessary to give you the cash that you need.
Right, or they just roll it in.
Right, exactly. So it's essentially when people say that they're rolling it in, that's basically what's happening.
Yeah. You're still paying for it.
You're still paying for it.
Paying for it over 30 years.
You're paying for it over 30 years, and that's okay. Yeah. It's okay to do that, but if someone is doing that, you should know about it. You should know that that is what's happening. And what I try to do with my clients is put together a worksheet that has all of these different loan options on one page and show them this is the standard baseline loan. If you were to pay for all of your closing costs and just get the best possible long-term investment, this is what that loan would look like.
Right.
Compared to us paying for your closing cost, compared to doing FHA, compared to doing conventional, or compared to doing down payment assistance, for example.
You got to compare it to like the par.
Right. Yeah. How do you know how good of a deal you're getting if you're not comparing it to anything else?
I think that's great advice. Now, there's a lot of crazy words that people hear. I kind of have a good idea what things are, but help me out. You got FHA, you got conventional, you got jumbos, you have investment property differences. Like obviously, investment properties are for investments, but what are these other ones? FHA, and I guess there's VA also. And other
VA.
Yeah.
So you've got FHA loans, you've got USDA conventional, and then inside of conventional, you have different types of conventional loans. You've got standard, home ready, home possible, home one. So it gets pretty crazy as far as the amount of flexibility you have for approval. Your VA loans are for veterans, obviously. Right. USDA loans are the one example of a true 0% down program. But USDA loans have a lot of limits. There are.
What is that for? Is it for ranch land or?
Yeah, well, it's not necessarily ranch land. It's just in general, it's not for homes that are in the Metroplex. So you could actually go to the USDA website and it'll show you a map of everything that would qualify for USDA. The issue with USDA, if you're thinking about moving out a little bit further away from the Metroplexes, is that they're some of the more difficult loans to qualify for. Really? You have to have a really solid profile. And so I never do USDA for a client unless I know that they're in a really good place. Because if they're very dicey, then you're going to have a lot of problems. The underwriting for those loans can be very sensitive.
And dicey means like self-employed? Or?
No, not necessarily. Dicey, when I think dicey, I really think about a person's debt to income ratio, which is basically a comparison of all of the income that they make compared to all of the debt that they have and will have with the house. Yeah. When you start pushing that debt to income ratio into the high 40s, low 50s, it may still approve, but that starts getting a little bit dicey.
Yeah, when people are spending too much money on their housing, we want to pull back on that.
Exactly.
Make sure everybody can really afford the house for the long term.
Exactly, and USDA is one of the most sensitive loan programs to debt to income, and you want to be very careful. FHA, for example, an FHA loan will let you push the debt to income ratio pretty high, sometimes 55, maybe 56% if you're lucky.
Because it's all about just getting people in, right? Like home ownership, and they're excited about people.
Exactly, yeah. And so we always have to be very careful about what loan programs we offer our clients, but more than anything, being able to teach them and educate them about how these different loans affect them long term and whether they should be trying to get into a program or not. I'll make one example. We teach a class about conventional versus FHA loans that I love to talk to people about because I do feel that something that I see happen often when I'm competing with other lenders is that I'm trying to get the person qualified for a conventional loan, but I'm competing with a lender that's doing an FHA loan. And so you always want to ask, if you are being placed in an FHA loan, why you're being placed in an FHA loan, because they're wonderful loans. They offer low down payments. You don't have to have super high credit. You in general don't require a high down payment because it's only 3.5%. And so they can be very favorable. But if you have a client that qualifies for both, right, and they have an ideal profile, they have strong credit,
right,
they have good assets, there really is no reason.
Well, conventional may be better because it doesn't come with
mortgage insurance, right?
Yeah,
so that's the big X factor is mortgage insurance with conventional loans, and I don't want to be placing clients in an FHA loan if there wasn't really a true need for them to be in one.
Right.
So oftentimes what happens is they get placed in those loans because it's easier to qualify. The debt to income ratio is higher.
Yeah.
You can go much higher.
Yeah.
And so somebody will say, oh, let's just go FHA.
It's just
faster.
easier
It's
to
easier.
do.
Mm-hmm.
So what are the advantages to a client of FHA versus conventional?
Well, FHA loans are going to require they require and have a lower credit threshold. So FHA loans you can approve with as low as a 580 credit score.
All right, so if I don't have fantastic credit, FHA is probably pretty good.
Absolutely.
Okay.
Mm-hmm. Yeah,
Or
it definitely is a good
money.
loan.
Yeah.
I don't want to give the wrong impression.
Yeah.
If you're not in a great place, if your credit maybe is a little bit spotty, FHAs are fantastic. They give you an opportunity to purchase a home, whereas you might not be able to on a conventional loan. But if you're in an ideal place, if you're in a great place, financially, credit-wise, asset-wise, and someone's trying to push you on an FHA loan, you should question that, because there should be a really good reason why that is happening. Because financially, the FHA loan is going to hurt. You have mortgage insurance that is paid in two different ways on one loan. You pay an upfront fee, 1.75% of the loan for an FHA loan, and then on top of that, you pay 0.85% on most FHA loans for the life of the loan.
Really?
Forever, regardless of whether you ever hit 20% or not, you are going to pay that MI for life. The only exception with
mortgage insurance stays on it as long as you have that FHA loan.
Right.
Even if you
hit 20% equity
or 50%, like whatever
exactly.
it is,
you're going to pay that for life.
How many people don't know that?
90% of people.
I didn't know.
Yeah.
You'd think I would.
Yeah.
Right?
I had this crazy story of a client that I was helping. I'll make it quick, but I was trying to get her overtime income from her job because I needed overtime income to qualify her for conventional.
Right.
And she could qualify for both. And the realtor I was working with, I guess, sent her to another agent, another lender that qualified her FHA. And then, later I heard the story of oh, it was super easy. I'm not sure why you had so many problems.
Yeah.
And what I told her at that point was that it was because I was trying to do conventional, because conventional financially was much better for her. We could have definitely done FHA, but that wasn't the point.
Yeah, that's the easy answer, but maybe not the best thing long term for her.
And so, oftentimes clients don't know that, and it's my job to do a better job of explaining that probably. So I could have probably done a better job of letting that client know why it was taking so long.
Yeah. Well, it's hard to explain everything all the time.
Absolutely.
Wouldn't get anything done.
They're both great loans, though. One of the biggest misconceptions I think about conventional loans is that yes, you do have to be ideal, you do have to have great credit, but that you have to do 20% down.
Yeah.
I think that right away that's something that most people assume, and that's not true. So if you're thinking about purchasing a home and you're being placed in an FHA loan and you think it's because you don't have 20% down, know that that's not the case. You can do conventional loans at 5% down. You can do them at 3% down.
Yeah, so that 1.5 extra that you put down really pays big dividends.
Oh, yeah.
Especially when you can let go of your mortgage insurance.
Of course, yeah. Conventional loans are by far the way to go. If you're in an ideal place with your credit and income, you want to try to do conventional because of that mortgage insurance, and in general, you just have way more flexibility about the types of mortgage insurance that you can get and whether it's going to come off or when, that sort of thing.
Yeah, so let's talk about two more kinds of loans. Jumbos also have become very popular, and I think the rate has gone up for where they start, the threshold where a jumbo is. Why do they cost more? And what are the pros and cons of maybe doing a second and a first? I don't understand why they cost more. I never have. And sometimes they're on par.
Yeah, sometimes they are on par.
Moves.
Here, let me tell you why. Jumbo loans are they're complicated. And the reason that they're complicated is because the normal loan limit now has changed to, I want to say 510 for standard conventional loans. So anything above that turns into a jumbo loan, and essentially every individual investor has an opportunity to say, I want to do jumbo loans, but I am going to determine what my guidelines are for jumbo loans. They have nothing to do with Fannie and Freddie Mac. We might follow their general guidelines, but I also have all of these other guidelines that I want to follow.
Their own ball game.
Right.
They get to decide however they want it to go.
Right.
The guy with the money makes decisions.
Pretty much.
Yeah.
So it'd be like if you decided you were, exactly.
Well,
and you just said these are the rules, and I had to follow those rules.
Yeah.
It's very difficult because what you end up having is, 20 or 30 different investors that do jumbo loans with 20 or 30 individual sets of guidelines for the way they want their jumbo loans done.
It gets a lot more
So
complicated on
when
your
we
side.
have clients that want to do jumbo loans, I tell them, are you sure? Because it's about to get really dicey. But no, we do them often. Obviously in this market, the sales price of homes are going up pretty quickly, and so you are in situations where jumbo loans are very, very common. And I would just say, if you are thinking about going that route where you're buying a pretty expensive home, you might want to think about doing a first and second lien. Those can tend to be a little bit easier. There are trade-offs to that. But if you are going jumbo, just be very, very sure that the lender you're working with is doing a really thorough job of vetting your file, not just for general underwriting guidelines, but specific to the investor that they chose for you. So if they've said, hey, we're going to do a jumbo loan, you should ask, who is the investor we're using? What are their guidelines? And am I going to meet those guidelines? Yeah. Because I can, if something doesn't work out with that specific investor, you can't exactly just fall back and pick any other investor.
Not if you have a deadline.
Exactly. So it gets a little bit more complicated. You just want to be extra careful. Not only do you want to be extra careful because of the difficulty, but the fact that your investment is much higher. You're talking about much larger earnest money deposits.
Yeah, more money, more everything. But like I assume they cost more because those investors decide that maybe it's a riskier time period in the market. And then, like I noticed in the 2008 to 12 slowdown, that it was really even. And in fact, and sometimes the jumbos were less.
Yes.
So were those guys? Is it a flight to safety? Is that what that?
Yeah, what I would have to tell you is, as far as that's concerned, is that risk is always going to be a price or a factor of how they price any loan. Jumbo loans in particular, they're automatically riskier. And one of the things I can tell you that we see, not necessarily statistical data, but just empirical data from doing the loans and being in them, is jumbo loans tend to have a pretty drastic reaction to the amount of down payment that you're placing. So there are some jumbo loan investors that will do really low down payment requirements, but the trade-off for that is that the interest rate is horrible.
But if I put half down, it's still a jumbo loan.
Then your interest rate must be better.
Or 25%, is it the usual?
Usually 25% I feel is where it really makes a drastic difference in terms of your interest rate with jumbo loans and also investment loans.
Yeah, well that's what I was going to ask next, because I know that if you do 25% down, that rate comes down a bit.
Pretty significantly, yeah.
And so like on investment properties, what are you seeing for down payments?
So investment properties vary, obviously. You can do investment properties, at least with us, as low as 15% down. The interest rate's not going to be pretty, but it's still an investment property at 15% down.
And then if you put 25% down, that's a very different number.
Very different number.
20%, it's somewhere
in between.
So it's just a seesaw.
It's a seesaw, and especially with investors, we look at so many more other numbers. We try to get an idea of what the projection is for the income they can make from this property.
Right.
Is taking that investment, or is taking that interest rate going to pay off still over time? Yeah. And then make a decision over whether 15% makes sense for them or not, and whether we have to wait to save more money or go ahead and put 25% down if they have it.
Right.
There are a lot of different decisions with investment.
So it gets complicated.
Because it's not a home, it's not like I have to live here anyway, it's specifically purchased to generate income, so we have to look at it a little bit differently.
I find we have two different kinds of investors. We have guys like me who really like leverage and appreciation, and so I want to put as little money down as I can, And then we have other folks who are like, I want to pay it off,
Right.
and have cash and all that's income. So it's
Everyone is different, and that's why every evaluation is on the spot, ad hoc for that client, because we all manage and think about our finances differently. And I want to give people an opportunity to just look at different ways to structure and then make decisions for themselves.
I think that's great. So when we have a duplex as an example that people are selling and both sides are rented already, say $1,500 a month,
Okay.
like how much of that can the borrower count as income to help qualify for the property?
Yeah, so that is like anything else in mortgage is complicated because it depends.
Better you than me.
Yeah, it depends on how long they've had the home and how they're reporting it to their taxes. So, as an example, let's say I lived in a home. Let's say it's not a duplex. Let's say it's just a single-family residence for this example, and I'm gonna move out of this home to go purchase a new home.
Right.
All I need is a lease. Of the person that's going to take over the house that I'm living in.
Okay.
And we can count 75% of that lease towards rental income for that property.
Nice.
So if there's a mortgage, we take 75% of the lease to offset the mortgage.
That's
If
wonderful.
there's not a mortgage, then we can count it as income, right?
What if you don't have the tenant? Can you count like a perceived income level?
You
Is that
cannot.
possible?
Not if you are moving out of the house to go purchase a new one. You have to have a tenant before the closing date.
Okay, so
They have to sign a lease and also deposit 1 month's rent.
So the folks that we have in our multi-unit Monday series, we can count 75% of the tenant's rents
Right.
towards their income for qualification.
Yes, with the exception of whether they've been renting it for multiple years or if they've owned the property now.
Well, this would be from the purchaser who doesn't own it at all yet to from the
Oh yes,
past.
yes. So they're buying this
existing
house.
tenants. Yeah,
They're buying this duplex and it already has tenants in there.
existing tenants.
Okay, so what happens in those situations is very different because now I'm buying a duplex that exists that already has tenants. So when we send the appraiser also does rent schedules.
Oh, cool.
And that appraiser gives us what the market rental value would be for those units based off of other duplexes in the area, and we use that as the income that can be offsetting the mortgage.
That's really cool.
So that's what I was saying is complicated because it totally depends on how it is owned. If it's going to be owned, and if I'm moving out now, or if I've been renting it for years.
Yeah.
One of the most common obstacles that occurs, and if you're out there and you own properties right now, and you are counting them at a complete loss, that can be a problem for you in the future.
You go to do a mortgage. Yeah.
Right, exactly. I own a condo that I rent out, and I have to be very careful this year. The taxes every year, so we'll say, hey, we made $14,000 worth of income, but I lost 30 grand, so I'm at a negative $14,000 income, and now I don't have to pay taxes, and everyone's happy. Well, if you're applying for S is what we have to use for that rental calculation. So you want to be very careful if you're thinking about purchasing homes this year or in the year that you're trying to purchase. How you file your tax returns on investment properties is very, very important.
Well, you may want to think about it 2 years ahead, right?
Yeah,
Because
absolutely.
you're going to look at 2 years back and average that.
Yeah.
So,
And so you always want to
plan
be very
ahead, guys.
careful with your property taxes. I mean, with your income taxes, because I feel there's a lot of misunderstanding about how all of that works because we're so constantly focused on trying to save money on taxes, but don't realize how that affects us when we finally try to buy something.
Yeah, I've run into that before.
You can't tell. I always just joke around. Uncle Sam, you're not gonna get around him. You can't tell Uncle Sam that you're not making any money, but then say, "Hey, I make all this money,"
and then show that you're making a bunch of dough. Yeah,
it doesn't work that way.
That's a complicated thing.
Yeah.
Well, that's wonderful. Well, thank you so much
Thank you for
coming
having me.
and explaining this very complicated stuff.
I hope it helps. I mean, I know it is multifaceted, and I hate being roundabout, but every situation is different, so we just try to do the best.
You can't really answer anything without real specifics, right?
Yeah, no. I mean, I have so many clients that want to wait on applying, but want to know specifics.
Yeah.
They want to know their interest rate, their cash to close. They want to know what they can qualify for, but they don't want to apply yet.
Yeah.
And so, impossible. We need some information to go by.
So what's the best way for people to follow you or ask you questions or check in with you to get more advice?
So you can go to Mortgage Man Texas, pretty much everywhere. If you go on Instagram, you can find me there, Mortgage Man Texas. You can also go to my website, alejandrojuarez.com, and it'll take you. Feel free to call me with any questions that you have. You know, regardless of whether you're already under contract and you just want to make sure if something is correct, I'm happy to help. We're here for you, so anything you need, let us know.
Yeah, well, thank you so much.
Thank you, man. Thank you. It's good to see you.
We have one question that they want to know who y'all got for the Super Bowl.
Oh,
Who do y'all
man.
have for the Super Bowl? Nice.
I'm gonna tell you that in terms of nostalgia, like what I would love, I would love to see the 49ers win the Super Bowl. Even though I grew up a Cowboys fan, a lot of my friends back home are probably freaking out for me saying that. But I just love to see classic teams win. That's
Well, they seem to be the leader in that category. This is embarrassing for me to say, but I don't know who they're playing.
Chiefs.
The Chiefs. Oh, the 49ers.
Yeah. I don't really.
Plus, a lot of our clients come from San Fran.
Yeah, exactly, right?
Like, it's hard to not root for that.
I'm gonna go buy a San Francisco shirt. Just wear it.
Well, cool, man. Well, thank you for joining us for
Thank
episode 25. I think I forgot to mention that earlier, but what a big deal that is, you know? I remember being 25. I bet you do too. We
Just
were
barely.
a lot sillier then.
Oh, absolutely.
Anyway, over and out.
Bye.
Thank you, guys.